Hello, everyone. It's Mitch Goldberg here. Thank you so much for joining me. Welcome to the show, Be the Boss of Your Money. Couple of topics to cover today. The first is we really need to start looking for opportunities. We need to be opportunistic. Markets change, economies change, some things don't change. We need to talk about this because I think people are trying to figure out a lot of things at the same time. And a time like this, it's important to get back to basics. So we'll talk about that, where opportunities could come up. Now, I'm not going to give you a list of like 20 stocks to buy right now that will get you through this potentially difficult time in the economy, the market, and everything will be great. I don't even want to give you stocks that'll get through the market right now. I'm actually looking at what's going to work past this market, past a potential slowdown in the economy. We'll talk about why we keep hearing about slowdown in the economy. But a big word, two big words, I should say, when you put them together, they're big, is operating leverage. This happens after every single economic slowdown, either just a slowdown, garden variety recession, or just a brutal great recession. We get into something called operating leverage, where companies cut costs so much they learn how to operate with less, fewer people, more technology. And when we come out of a slow economy and the economy accelerates, these companies see just a massive ramp up in their earnings, in their operating leverage, and they make more money because they learn how to do business in a slower economy. And when the cycle turns, these companies do great in a recovering economy. That is really where I think we need to start putting some chips away, putting some chips on, as opposed to just saying, let's just own more T-bills, own more treasuries, own companies that might be more leaning in toward manufacturing in the United States, or just a handful of large cap companies like Walmart, Target, Home Depot. You know the companies I'm talking about, Meta. So there's a lot to think about, and that's what we need to consider. So we'll talk about why a down market is your friend. This is like a long intro, so let me just throw in the intro now, and we're going to have a quick discussion about this. While you're watching, I ask you to please give it a thumbs up. Whatever channel you're watching from, connect with me. I'm on LinkedIn, I'm on YouTube, Facebook. I also am on Instagram at InstaMitchG, and I post snippets of these shows every day also, so you can catch the quick highlights of these shows as well. It's all educational. I'm just calling balls and strikes in the stock market and the economy, and focusing on the financial planning aspect of things, because we'll get through this. And I just want people to make the right decisions for their future, not make the wrong decisions because they're just worried about the here and now. Okay, so here is the intro, and here we go. All right, thanks so much for joining me. I'm Mitch Goldberg with the wealth management firm Client First Strategy. Let's talk about some opportunities. What has changed? What's permanent? We talk about the tariffs a lot. A lot. It's all we talk about, right? Because there's nothing really bigger than that. We can talk about politics. It's hard to talk about politics. I'm neutral. I don't get into taking sides. I knock different administrations and policies. I want the economy to do well. I learn from policy mistakes, and sometimes I see policies that I don't agree with because I think they're going to hurt the overall economy. Some policies are benefit the stock market only, and some policies benefit consumers generally. We talk about these things because you have to make a decision. Investing favors people who can put money away. That's why they're investors. You buy a stock and you have a gain, and you sell it. And if you hold the stock for more than a year, you only pay 20% capital gains tax. A little more depending on your income, but roughly it's 20% for most people. And that is a lot better than paying income tax. We have Roth IRAs, which means your money could grow not just tax deferred like a traditional IRA, but it's tax free because when you take the money out of the IRA, it's tax free. All right. So there's some advantages. People who have money are able to take advantage of a down market by converting their traditional IRA money into Roth IRA money. There's a lot of advantages, some things people don't even know about. So these are the things that I want to always remind you are really, I think, more important than what the stock market is doing this month, this quarter, or even this year. All right. So a lot of places to put money, and there's been a big focus in asset preservation because that's what happens when the markets get scary. And we hold on to, generally speaking, as investors, more cash. We put more of our brokerage accounts and our IRAs into the money market sweep account or money market mutual funds or T-bills or, or other cash equivalents. And we want to preserve. But then we want to switch back and get into growth. And I think that's really tough to do. And some people are disappointed that they didn't take more chips off the table when the getting was good the second half of last year and the very early part of 2025. Keep in mind, folks, that we're not down that much from all-time highs where, the all-time high from January to February was like an extra little oomph to the all-time high mark. But generally speaking, from last year to now, we're off a couple of percentage points, maybe 5%, 6%, maybe 4.5%. I haven't checked today. I don't think it's worthwhile checking every day, but the bottom line is we're still in pretty good shape. Now, if you are an individual stock investor and you have a Marvell Technologies, for example, or you paid too high for Tesla, for example, you're hurting for certain. I understand that. But hopefully you don't just buy two stocks. Hopefully you know how to diversify. Diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Looking for opportunities are going to be like this. Companies will learn how to source their assets from other parts of the world, their inputs. They will learn how to make more stuff here. But I don't think it's going to be a gold rush of companies making more stuff here. The thing about tariffs and executive orders is that they could be reversed by the person who implemented them. They could be reversed by another administration. And it doesn't mean that the next administration, for example, now has to go from Democrat. Sorry. Doesn't mean it has to go from Republican to Democrat. You might have Trump now and another Republican who wins the next presidential election. And that person might say, you know what, I think we've had enough. That person could change their mind and do what they think is best for the economy and their political future and things like that too. So none of this stuff is permanent, which is why it's going to be tough to expect a lot of companies to just turn around and start manufacturing a lot here and putting stakes in the ground and putting in new factories. It's going to take a long time for that. There are companies with excess capacity in the United States, and they're going to fill up that capacity, and that's good. And I think it's good that we can manufacture more things and have more jobs here in the United States. Keep in mind, I don't know if we can even fill all the jobs that people want. Americans tend to retire low to mid 60s. And we tend to be a services economy. Having said that, I see opportunities in everything that I saw opportunities before. There are opportunities in financial services. There are going to be opportunities in healthcare, pharmaceuticals. There are going to be opportunities with utility stocks. There's always an opportunity. I hate to sound like that other guy on TV always says there's a bull market somewhere, and I'm here to help you find it. I'm not looking for a bull market today. I'm not looking for a good month or a quarter. My clients know this. When they see a stock in their account, I mean, it's common for my clients to see a stock in their account for 20 years or more. I'm a super long-term holder. It doesn't mean I get married to a stock and watch it go down. When the stocks go up a lot, typically if they go up a lot and quickly, I take gains. I have some stocks that are up a lot that I've never sold any of it for clients because I prefer a stock that builds its gains slowly over time than a company that just has a good 6 months or a good year and goes up like 200%. I want to start taking profits off that. It typically takes me a long time to sell 100% of a particular stock holding because it could keep going up, and you never know if the miracle happens and the company becomes the next multi-trillion-dollar company, like what happened with Apple and Nvidia and other companies. I want to be in it for the long run. In fact, that's what I did with certain companies like Nvidia and Meta and Google and a few others, and it's worked out very, very well. I just don't have as much today as I had 3 years or 4 years ago, but we're still in it to win it. But I think it's prudent to take some gains off the table and reinvest elsewhere. What are you reinvesting? These are the important things that we need to talk about, not just say, we're living on a distribution channel, the ships are slowing down coming into port. We know all that. You get all the news there is. I like to be early in the news reporting to you, but at this point, it's, we already know it. And the situation changes so quickly in the news that by the time you read up and you think you're well versed in current events, an hour later it changes. For example, show you a quick headline. All right. Trump downplays tariff talks. We don't have to sign deals. This came out today at about 2:00. We don't have to sign deals. Now, stock market went down. It started to recover because Scott Bessent and Howard Lutnick in the administration, Bessent is Treasury Secretary, Lutnick is Commerce Secretary, said, we have deals coming with all these countries, and Trump has been saying that. So they're getting us juiced up to think, oh, they've got deals coming up. So maybe the market's down too much. maybe we got too negative, and the stock market goes back up. And then people keep asking, where's the beef? Remember those Wendy's commercials? Where is the beef? Now it's like, where's the deals? We didn't get any deals over the weekend. So now it's like, are you really talking to all these countries? I mean, countries have embassies. They're always talking to each other. But are they talking shop? Are they talking business? Are they talking tariffs? Okay, that's what we really want to know, and we don't know. So that Trump says we don't have to sign deals. These countries have to sign deals with us. It's a way of backing off and lowering expectations. So we don't, because he said he's on TV today. He said, I'm tired of people asking me this. Just calm down. We'll have deals. We can announce 100 deals in one day. We'll see. But I think the administration is running into the issue that we don't have patience. We like to get our returns in the stock market fast. We buy Bitcoin. We want that stock. We want that crypto to go up fast. We buy Nvidia. I bought Nvidia. How come it's not up 30% in the last 3 days? We have these expectations that we can do things quickly in the economy. And I think the biggest bear market is actually patience. I'm not getting into a tizzy with the stock market up and down. My clients know that. We're in it for the long term. Now, if you're 65 or 75 or 50, we could go through every age you want. There are different concerns. So the next important thing to talk about is glide path. I was talking to my friend Jeffrey out in the hall. I'm friendly with all the people in the hallway up and down in my office building. And one of them says, I'm 62. This does get me a little frightened. My kids are 30. They don't care, or 30 or 29. They don't care about this. I tell them, don't worry about the market. You've got plenty of time to worry about it. But see, this is why we hear client first. We start our glide path in advance. So that means, let's say, my little commercial, you're 55, we start building up on bonds. It could be 50 for some people, it could be 51 for some people. It's not a one-size-fits-all approach. But we start getting a little bit out of risky assets and start getting into what we consider more stable assets, like the bond market, short-term, intermediate bonds, long-term bonds. We start looking at preferred stocks, corporate stocks, utility stocks. Utility stocks are stocks; they're volatile, but typically speaking, utilities compared to industrials or tech are historically considered less they're considered the lower volatility part of the stock market. REITs also. And so we start this changing of people's portfolios gradually. So by the time they're in front of retirement, they've already done it. In other words, you don't just retire at the age of 64 and 64 in one day. You go from aggressive growth in your investments to, moderate growth or conservative growth or income investing. It's a gradual process. The reason is negative sequence of returns. That means if the stock market goes down when you do this all at once, you're making permanent losses. It's making it very difficult to recover from those losses, if ever, especially when you're at a point when you're starting to liquidate your accounts because you're using your investments that you've accumulated over a lifetime to start paying your bills after you've stopped working. That's why we find the right glide path for our clients. It's one of the most important things we do for our clients. It's really important. The firm is called Client First, but if I had to change the name, I probably would change it to Glide Path. That's how important this is. And the glide path is different for everybody. And just because somebody's going from, let's say, 100% to 90 to 80 to 70 to 60% stock, some people could do that in 5 years. Some people, we might do that over an 8 or 9 or 10-year, 20-year period. It just depends. These are the important things that are much more important to talk about than the stock market. I've said a bunch of times, I'm not really that worried about the stock market. Eventually, new companies will replace the big ones today. Eventually, eventually the top 10 or 15 stocks in the S&P 500, eventually the top 10 or 15 stocks in the S&P 500 will change, and we'll have a new crop of mega cap stocks. By the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. So we will have new growth. If you look at the top stocks in the S&P 500 and 2000, they're very different than they are today. And I expect in 20 or 25 years, they're going to look different again. We all happen to believe that, well, whatever the big companies are of today, of our time, that's what's always going to be big. But it changes. How many of you expected Meta, which is Facebook, to be such a big company today? A lot of people thought social media was this like weird, silly thing, and now there's basically, it's like there's two internets. There's the Google internet and there's the Meta internet, right? Some people will say that Reddit is like its own little internet, but I don't think it's quite big enough to be in the league of another internet yet. So these are the things we need to talk about. I wish I could give you the answers in the stocks now. Now let's talk about big plays, like big calls. Paul Tudor Jones said today that Paul Tudor Jones, and he's extraordinarily highly respected investor. He made his first mark by making a ton of money when the stock market crashed in 87. I guess he was short and he went long and he made a ton of money. And he continues to invest money. He says, he says, stock market will hit new lows even if Trump cuts tariffs to 50%. Maybe. And yesterday there was another very big, serious negative call. And there were also some pretty big calls for the upside. I don't take these ginormous market calls that seriously. It doesn't change anything at all for the way I would invest client assets or my own assets. One day, let's just sell everything because someone said the market's going to go down, and then let's buy everything back because someone said the market's going to go up. And right now, if we had a really, remember in the last 2 weeks or so, 3 weeks, you had a pretty big rally in the stock market. It's petering out this week, but you had a big rally like the last couple of weeks. And people are coming out of the woodwork. This is going to be a big market. We've got more upside. And then it starts to go down. The people who are negative get called on by the media. I'm not a media basher. I'm just saying that this is the way it works. Headlines, eyeballs. All right. I take this with a giant grain of salt. I don't really worry all the time about this stuff. We're investing for the long term. I recently said to a client, he says, "Well, what do you like? What do you favor?" I said, "I'm only now favoring diversification. I'm investing for diversification because the market's too uncertain to say let's overweight industrials or overweight financials or overweight this or overweight that. Plus, if I'm overweight in one sector, now I have to know when to underweight that sector and overweight another sector. And I usually am somewhat overweighted one particular sector just because of the way my stocks grow. Like everyone was overweight technology or tech related stocks because just the way they went up so much that you couldn't help it. That's why tech became about 35-40% of the S&P 500. You can't help it. And that's why it's up to me to trim it back. So maybe the S&P 500 is 35% technology, and maybe my client could be 20 or 22 or 18% or 15% technology. It all depends. It really does depend. So I'm really focused on diversification, and I'm looking at opportunities. There will still be opportunities in construction. There will still be opportunities, even caused from inflation. Prices are at a new plane. See, inflation's a funny thing. Inflation measures the rate of how much prices go up in a specific amount of time. If prices went from $10 a unit to $20 a unit in 1 quarter, that's 100% inflation. But now if that $10 to $20, now if that item stays at 20 for the next quarter, it just stays at 20, we're going to say, oh, inflation is flat. Because that $20 could be considered a new price plane, a new economic level. And now we have to price things off of that. I think we're going to a new permanently higher plane. That's what happens with the end of globalization. So will people be buying less? As Trump said, people will buy $2 and pay more for them instead of $30. I don't know anyone that gets $30 for one holiday present, in Christmas or whatever. But I realize he was just saying that to make a point, and people are jumping all over that, and people are jumping all over that to make political hay, out of a soundbite. I believe me, I understand. All right, you probably wishes you said that phrase a little bit differently, but the idea is that we will be better off in the long run by having more manufacturing and being more self-reliant as a country. We'll be more secure militarily and economically. Is it worth the sacrifice to do this now? Clearly, President Trump thinks it's worth the sacrifice. You have to admit, it's long-term thinking. Most presidents would never do what he's doing because they'd be afraid of the political ramifications. So you have to admit, I admit it. It's pretty cool. I don't agree with the shock and awe of it, but it's not up to me. I'm not a policymaker. I interpret, I give you my impressions, my objectivity, the benefit of my 36 years of experience in this field, and then I want to build portfolios out. My portfolios that I create for clients now are not particularly that different from what I was doing 3, 4, 5 years ago, 10 years ago. The biggest thing is the glide path. What percentage of bonds, cash, and stocks, equities, fixed income, and cash, that changes. But within the stock portfolio, still buy healthcare stocks, still have financials. All right, we still have all these. But it does make me think about, in the pharmaceuticals, where should I be? In financials, where should it be? In industrials, where should it be? All right. Where should that be? So these are the things that we need to focus on. A couple of things that are going to change. Our export markets are going to change drastically. Every country in the world that has American imports, or for us, American exports, is going to do their best to create alternatives, redundancies in their supply chain. Brazil now is going to be selling their soybeans and other crops to China. That's going to permanently replace American agricultural products. These are the kinds of things that, but Australia and Brazil are great at growing beef and pork. That's going to be a big change. So these things I could see changing. So how does that affect us? I mean, I wouldn't be surprised if you see the price of protein, chickens, pork, beef, plunge. Well, maybe plunge is hyperbole, too much hyperbole. But I wouldn't be surprised if you see prices in those proteins go down for a while, because now if we're not selling our stuff to China, because China has other sources, farmers have to slash the prices to get rid of this stuff. All right. I don't think it lasts a long time. If you see the price of produce go down, it's just that there's some vendor out there or some agricultural producer who's probably about to go under, and they need to dump their stuff in the market just to get some cash to keep the lights on and pay the debt. So things are changing. And I think that most consumers and most investors are looking at the changing situation with tariffs in a state of, I don't see anything wrong yet. Personally, I went to Costco this past Friday. I got my Bounty paper towels. I got everything I wanted. No problem. Didn't feel like I was paying extra for stuff. I mean, I was surprised the bill was almost $500. Maybe it would have been a little less a couple of months ago, but no big surprise. We haven't seen the ramifications of trade yet in the real consumer economy. We're seeing it now in the ports. We're seeing it in the supply chains and the distributions. If it's reversed, we'll have a couple of months hiccup in prices and the economy, and we'll start to get back to normal. But what I'm going to look for are the companies and sectors that are permanently changed to focus on. And that's how I'll start to pick my spots. And when I know this, I will share it with you. And if you want to know it firsthand, you want to have a conversation with me, please give me a call. All right. So that's about it for this show. I appreciate you watching. And if you have any questions, reach out. All right. Thanks. And I'll see you tomorrow. Bye.